Hello, 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 hello. Welcome to our next chapter, that is Advanced Capital Budgeting Decisions. This chapter has been newly introduced in CA Final. So earlier this used to be only tested at intermediate level. Now it has also brought into CA Final. So before we start with the chapter, let's understand how many marks does this chapter come from, and then we'll study accordingly. So your chapter, this is chapter number 3 that we are doing, and chapter 3 comes for about an average of 8 marks. So this is a very simple chapter, nothing to be worried about, free marks. And we will start with this chapter. So it is very similar to the chapter that all of you have studied in intermediate. It is just a little advanced, a little changes. So we'll see what all is different. Okay, perfect. So the first part that we are doing is we are understanding the impact of inflation on capital budgeting decisions, because of course as the years increase, as the years progress, our cost and revenue both will change based on inflation. So we've included the formula here as to how do you calculate this. So after tax cash flow from project, if you want to calculate the after tax cash flow, what do? You will do revenue minus cost, but do not subtract depreciation from this. Okay, so it excludes depreciation. So when you do revenue minus cost, do not subtract depreciation. Basically, exclude depreciation and any non-cash expenses. Is that clear? Because see, what we are trying to understand, what we are trying to achieve, we are trying to achieve cash flow. We are trying to achieve cash flow, and since depreciation is a non-cash expense, so isliye we are, so therefore we are not subtracting it. So you'll do revenue minus cost, and then you subtract and you multiply it by 1 minus tax, because of course you have paid 30% tax. So what is remaining is only 70%. So this will be multiplied by 70%, that is your 1 minus tax, assuming tax is 30%. However, because of depreciation, you also get a tax benefit, that is what we call as tax shield. So you will be adding that back. So depreciation into tax will be added back. Basically, depreciation or any non-cash expense multiplied by tax will be added back, because you get a tax shield on that. Okay. Your second formula is, sir, how do you do how do you differentiate between discount rate, nominal rate, and inflation rate? Okay. So there is a thing called real discount rate. Real discount rate is basically excluding the effect of inflation. So 1 plus real discount rate into 1 plus inflation rate will give you 1 plus nominal discount rate. So what is the use of this? Why are we using three different? Because if if in the question, if your cash flows are adjusted with inflation, then in such a case you will discount it by this rate. If your cash flows, if your cash flows are inflation adjusted, then you will use the discount rate of nominal discount rate. However, if the cash flows are not adjusted with inflation, then in such a case you will be using the real discount rate, basically without taking into effect the inflation rate. So this is if cash flows with no inflation effect. Is that clear? Correct. Because the cash flows will have to match the discounting rate, or you can say vice versa. The discounting rate has to match the type of cash flow. If the cash flow is adjusted with discount rate, you will use nominal discount rate. If it is not adjusted, you can use real discount rate. Okay, let's solve an example. Our entire notes I have kept on repeating. Whatever is in the color will be part of your question, and whatever is in black will be part of your answer. Okay, so let's study a small example on this. Initial outlay is 40,000. Okay, our initial outlay is 40,000. Life is equal to 4 years. Life of the project is 4 years. Initial investment is 40,000. Cash flow. Cash flow they've given excluding inflation. Excluding inflation. Cash flow excluding inflation is 15,000 per year. Okay. Cost of capital is 12%, but over here this includes inflation of 10%. See what, are you seeing what they did? Your cash flow is without inflation, but your cost of capital, that is your discounting rate that they've given, is including effect of inflation. Sir, how do you approach this question? You can approach this question in two methods. You can either make the cash flows such that they are adjusted for inflation, or you can change the rate of the cost of capital and do it without inflation. So we will study both methods. Okay. So your method one is where you adjust the cash flow. That is, you put the effect of inflation in cash flows. Your inflated cash flows will now be 15,000 into 1.1. Is that correct? Because our inflation is of 10%. So take your calculator, do 1.1 into 15,000. You will get cash flow for first year, that is 16,500. Okay. Then again you press equal to, you will get cash flow for second year, that is 18,150. And similarly, you will get cash flow for 4 years. This is after giving effect of inflation. Once you have got your inflated cash flows, now you will discount it with the nominal discount rate. Correct? So your nominal discount rate is what they've given in the question, that is 12%. So you will bring back all of these values at 12%. You will calculate the NPV at 12%, and then you will subtract 40,000, which will give you an NPV of 17,369. Okay. You can pause the video, solve it, and then we'll move forward. Next is your method two, that is where you are adjusting the discount rate. So the question has given us a nominal discount rate. We will bring it back to the real discount rate, that is without effect of inflation. How do you do that? The rate that we've been given is 1.12 and inflation is 1.10. So basically, this will come in the denominator. Is that right? So we will discount it by 1.1 and we get a rate of 1.8%. So this 1.8% that we have calculated, this is real discount rate. Okay. Now that our discount rate is also without inflation and cash flow is also without inflation, tell me, can we calculate this or not? So now we will discount the 15,000 per year with 1.8%, and we will subtract 40,000, which will give us an NPV of 17,367, which you see is very similar to the NPV that we calculated in method 1. Great, this is clear. Let's move on to the next topic. So I hope everybody is clear. You either adjust the cash flows or you adjust the discounting rate, but both of them should either be giving effect for inflation, or both of them should not be giving effect to inflation. Our next topic is methods of incorporating risk in capital budgeting. Whenever in AFM we talk about risk, we are talking about only one thing, that is your standard deviation. Your standard deviation is how we calculate risk. Okay. So basically there are three techniques of risk analysis. First is your statistical, second is conventional, and third is other. So we will be going through each one of them. So first we will be understanding how do you calculate it statistically. So in statistically, that would be probability, variance and standard deviation, and coefficient of variation. In conventional, we will be studying about risk adjusted discount rate and certainty equivalent. And in others, we will be doing sensitivity analysis, scenario analysis, simulation, and decision tree. Okay, the other part is very, very interesting. So please stay and watch the entire video. Okay, great. So first, let's understand how do you calculate risk via the statistical methods. So statistical methods talk about probability, variance, standard deviation, and coefficient of variation. Let's first understand what variance is. So variance is a measurement of difference between the average of data set from every number of data sets. Sir, I didn't understand what you're saying. Okay, let's give you an example. Say for example, I have two type of data sets. My data set 1 and my data set 2. Okay, let's see, we have average marks, or let's say we have marks scored here. Okay, we have marks scored here and we have students 1 to 5. Student 1, 2, 3, 4, and 5. Okay. In data set 1, the marks scored out of 100 have been 90, 90, 90, 90, and 90. Assume everybody has scored 90 marks. Tell me what will be the average of this data set? It will be 90, correct? Let's see the second data set where one student over here has scored 10 marks. This student has scored 80 marks. This student has scored 70 marks. This student has scored 100 marks. And this last student has scored 70 marks. Tell me what will be the average of this data set. Let's calculate. We have 10 plus 8 plus 70. 100 plus 70 gives us 330 divided by 5. So we get an average of 66. Okay. Now tell me, if if you tell somebody only the average, is that a true indicator of the data set? No, because in this data set, everybody has scored very close to the average, or our example, almost the same as average. But in this data set, people are widely varying from the mean. Correct. So therefore, variance becomes an understanding, because in this data set, your variance would be 0, that is in data set 1. However, in this data set 2, your variance would be very high because each of these individual values vary a lot from the mean. So therefore, greater the variance, greater is the difference from the mean of each data set. Okay, now that we know what variance is, let's understand how do you calculate it. So the formula of variance, also represented by standard deviation square, is your net cash flow minus expected cash flow whole square into probability. So first we will understand in this case how do you calculate variance when probability has been given. In the portfolio management chapter, we have studied this in more depth as to how do you calculate when variance, how do you calculate variance when a probability is given, and how do you calculate variance when historical data is given. Okay, so this is your variance. Next comes your coefficient of variation. Coefficient of variation is basically risk borne for every percent of expected return. Every percent of expected return. Basically, this is a ratio. If you see, this is a ratio of how much risk I am taking divided by what is my expected return. Basically, my mean. It is risk per unit of expected return. Okay, so this is basically your mean return. If you check the formula also says the same. It is standard deviation divided by expected return. Standard deviation is nothing but this, and expected return is basically your mean return. Is this clear? And this we've already studied. Standard deviation is basically root of variance, because variance is nothing but standard deviation square. Okay, let's see a question. Let's see an example of how do you calculate variance when probabilities are given. So whatever is in red is part of your question, and whatever is in black is part of your answer. So consider where there are 5 events A, B, C, D, E, and they have given us cash flows for each event. Okay, they have given us cash flows for each event. They have also given you probabilities as to what is the probability that each of these events will occur. If you see, the sum of all these probabilities will be 1. So they have given this for project A, and they have also given for project B. The question in this is whether to choose project A or project B. Understood? So we have to help them decide whether project A is more favorable or project B is favorable. But if you see in this question, our initial outlay has not been given to us. So, sir, how do we calculate NPV? You will not be calculating NPV. What you will be calculating is coefficient of variation. You will be calculating coefficient of variation, because we want that we take the least risk, but we get the most return. That ratio is what is beneficial. Okay, so whenever you have to compare two projects, you can compare them via coefficient of variation. Okay. So now we will be calculating our expected cash flow, that is your expected value. How do we do that? We will multiply cash flow with the probability. So 10,000 into 0.1 gives you 1,000. 12,000 into 0.2 gives you 2,400, and similarly you will get expected values. You do this for project A as well as you do this for project B. Is this clear? Any doubts? Let's move forward. Great. So this you've calculated the expected value. Now you sum it. You sum it, and this 14,000, this 14,000 and this 18,000 that you are getting, this is basically your expected value. This is your mean. This 14,000 is your mean for project A and 18,000 is your mean for project B. Is this clear? So you've calculated the mean. Now how do you calculate variance? Your variance would be your mean, that is 14,000 minus 10,000 squared. Is that clear? Tell me, is that clear? You do 14,000 minus 10,000 into equal to, and you will get 1 crore 60 lakh. Now you multiply it by probability. You multiply it by probability and you will get variance of 16 lakhs. Multiplied by 0.1, you will get the value of 16 lakh in your calculator. Great. So what did we do? We calculated mean, then we subtract mean and cash flow, and then we square it, multiply it by probability. You will get variance for each of these rows. Once you sum this, you will get 48 lakh. This 48 lakh is your variance for project A, which we have mentioned over here. And then you get over here similarly, that is 1.76 crore, that is your variance for second project. Is this clear? Once you've calculated the variance, standard deviation should be very easy. Nothing you have to do. You just have to root your variance. Root of variance will be your standard deviation. Expected value we've written here 14,000 over here and 18,000 over here. Right? Now it is very easy to calculate coefficient of variation. For coefficient of variation, what did we need? We required standard deviation and we required expected return. We got both of them because we calculated variance, we put a square root over it. So we calculated standard deviation. Mean we had already calculated, that is your expected variance. So we just divide it. You divide your standard deviation with your expected value, that is 2190.89 divided by 14,000. Does it get you 0.156? Correct. So over here we've calculated 0.156 and 0.233. You have to calculate, you have to find which project is favorable. Tell me, higher the better or lower the better? What is the formula? The formula is risk upon expected return. So the lower the risk that I take per unit of expected return, isn't that better? So therefore, lower the better. Our project A is lower than project B. So therefore, your project A is a more favorable project compared to project B. Is this clear? Did you understand how we use coefficient of variation to decide between two projects? Clear? Okay. Let's move forward. Let's move forward. Perfect. Now we are going to our second part, that is your risk adjusted discount rate and certainty equivalent. So what do you mean by risk adjusted discount rate? Basically, you use discount rate to discount your cash flows. But if a certain project has more risk, doesn't it make sense that we increase our required rate of return, that is by what we are dividing? We take the effect of risk as well and then we divide it. So basically risk adjusted discount rate is exactly what it sounds like. Higher returns expected from riskier projects. So in, therefore, you will be discounting it with risk-free rate plus your risk premium. Whatever risk premium you are taking for the project, you should be calculating, you should be using that in your calculation for discounting. Next is your certainty equivalent. Certainty equivalent talks about guaranteed return the management would accept. rather than accepting a higher uncertain return. See what they are comparing? They are comparing that boss, you can give me a guaranteed return versus a higher uncertain return. Give you an example. Oh, where did we go? Right. I'll give you an example for this. Say, for example, what is this? Right. Say, for example, you have entered a lottery. Okay. You have put 500 rupees in the lottery, and the odds of you winning is 1 is to 7. Okay. The odds of you winning is 1 is to 7. The return, basically, your chance. Wait, let's take a better. Basically, your odds of winning is 1 is to 9, which is equal to 10% win probability. Okay. There is a 10% win probability. And if you win, you will be getting 3000 rupees. Okay. So basically, this is a uncertain, uncertain with a 10% probability of getting 3000. They are asking ki what is the certainty equivalent, that at what amount will you be happy if I tell you that it is 100% certain. Correct? So in this case, there is a 10% probability that I will be getting 3000 rupees. Right? There is only a 10% probability that I will be getting 3000 rupees. So what will be the certainty equivalent? The certainty equivalent will be nothing but 3000 into 10%, which is equal to 300. This is my certainty equivalent. Is this understood? 300 would be my certainty equivalent. Basically, what I'm saying is this 3000 with a 10% probability is the same as 300 guaranteed return. Clear? Let's solve a question on this. It will be better. Yes. So the lower the certainty equivalent coefficient, the more risk loving the person is. Let's understand what certainty coefficient is as well. Okay. So we have our example, our initial investment. Your initial investment is 25,000. Your risk free is 2%. Risk premium is 3%. Basically, what we will be using to divide is nothing but 5% because we will be doing a risk adjusted discount rate. They have asked you to calculate what is the NPV. And they've also given you 3 years, year 1, year 2, year 3 with expected cash flows of 10,000, 12,000, and 15,000. Okay. Your certainty equivalent coefficient is basically, this means that there is only a 90% probability that you will be getting 10,000 cash flow in year 1. There is a 85% probability that you will be getting 12,000 in year 2, and there is a 15,000 probability that you will be, and sorry, there is a 82% probability that you will be getting 15,000 in year 3. Is this clear? So basically, now you have to calculate the NPV of the project. What do? You will multiply. You will multiply 10,000 into 0.9 to get what is the certainty equivalent amount that you will receive. And then you will discount it by the discount rate. Nothing different you are doing. You are multiplying 10,000 by 0.9 and then you are dividing it by the discount rate, that is 1.05. Year 1 will be 1.05, year 2 will be 1.05 square, and year 3 will be 1.05 cube. Is this clear? So you will calculate that this is my present value of certainty equivalent cash flow. If you were to put this in words, this would be present value of certainty equivalent cash inflows. Is this clear? Yes? Okay. Now you will calculate NPV. You have present value of cash inflows. You have initial investment that is 25,000. That is your cash outflow. Subtracted, you will get an NPV of 3448. So in this case, we have adjusted. Basically, we have adjusted for probability, or you say certainty equivalent coefficient. Perfect. Next is your sensitivity analysis. Sensitivity analysis. What does sensitivity analysis mean? They are asking you that basically every project has a lot of variables. Correct? Variable could be your selling price, variable could be your cost, variable could be your life of variable could be your quantity that you are selling, variable could be anything. So therefore, sensitivity analysis basically it calculates change to NPV by changing only one variable. Is this clear? How much will my NPV change if my only one variable changes? Correct? Okay, let's study an example. In the example, there is an initial capital of 400 crores, annual unit sales of 5 crores, selling price per unit is rupees 100. Okay. Variable cost per unit is 50. Okay, so variable cost per unit is 50, selling price per unit is 50. So my contribution is 50, correct? Perfect. Next is your fixed cost per year. Fixed cost per year is 50 crore and discount rate that they've given us is 6%. Question A, calculate NPV if the life of the project is 3 years. Okay. Part B, what would be the impact on project NPV with a 2.5 adverse impact on each variable? So see, they have not clearly told you that you have to do sensitivity analysis, but you should understand that because the question is asking that if each variable has an adverse effect of 2.5%, how will my NPV change? You have to understand that this is a question of sensitivity analysis. Okay, let's go through as to what the answer would be. Yes. So basically your net cash inflow per year, net cash inflow per year would be your selling price minus variable cost, which is nothing but your contribution. You multiply it by annual unit sales and you subtract fixed cost per year, that is your 50 crore. So you will get 200 crores, right? Perfect. So let's first calculate NPV, assuming that there are no changes, that is for the base. So your selling price per unit is 100, variable cost is 50, contribution what you get after subtracting is 50. Correct? Then your annual unit sales is 5 crore. So you multiply your contribution per unit with total sales and you will get a total contribution of 250 crore. From 250 crores, you will subtract 50 crores fixed cost, which will give you a net cash inflow of 200 crores. This is the same 200 crore that we calculated here. You will do present value of cash inflow. Present value of cash inflow, what will you divide it by? You will divide it by 1.06. Okay. So present value, what is the life? Life is 3 years. So 200 divided by 1.06 plus 200 divided by 1.06 whole square plus 200 divided by 1.06 whole cube. You will get 534.6. This is your present value of cash inflow. What was your initial capital outlay? Initial capital outlay was 400 crores. So when you subtract it, you will get 134.60 crore. This is the NPV as per the base case. There is no difference here, nothing complicated, just as a normal vanilla question. Now what we will do, we will be changing each variable. So basically we have set up 5 cases. This is your case 1, this is your case 2, your variable cost per unit is case 3, fixed cost is case 5 and units sold is case 5, right? So basically in each of the case we will be making change to only one variable, and that variable I have highlighted in light red so that you know which variable we have changed in each case. We will be doing this calculation for each case only after changing one particular variable, and we will be calculating the NPV. So once we do this, we calculate that, oh, the NPV in this case is 124, it is 101, 117, 131, and 117. We have calculated NPV for our base case and 5 other cases where we have changed only each variable by 2.5%. In our case one, that is initial capital, our adverse would be when capital increases. So do 400 plus 2.5%, it will give you 410. In case of selling price per unit, your selling price will reduce. That would be an adverse. Do not add 2.5% in each case. Understand that for selling price, for a 2.5% adverse effect on selling price, you will have to subtract it. So in selling price, we have subtracted, in variable cost, we've added, in fixed cost, we've added, and in units sold, we have subtracted. Now we have to understand that which of our variable is the most important, because of which variable even a small 2.5% change would have huge impact. So how do you calculate this? You will calculate this with the base, you will compare it with the base case. So you will compare 124.60 with the base case of 134.60, and you see that there is actually a net change, that is net fall of 7.43%. Similarly, for each case you will calculate and you will see that the most fall is in case number 2, that is when my selling price per unit change. Why this sensitivity analysis is so important? Because this tells you which out of these 5 variables is most crucial to you. A simple 2.5, a simple 2.5 percentage fall in my selling price per unit will bring my NPV down 24%, 24.82, almost it will bring it down 25%. Therefore, it becomes very important for me as a business to make sure that my selling price per unit does not fall. Correct? So therefore, change in selling price has maximum effect of NPV of 24.82%. Is this clear? Let's move on to the next one. Perfect. Next is your scenario analysis. There is nothing complicated in this. In scenario analysis, what would they give you? They would give you 2 to 3 scenarios with regards to worst, most likely, and best case scenarios. Question will specify which scenario to use for which year. Say, for example, they will give you year 1, 2, and 3. And they will give you 3 cases. That is your best case, your worst case, and your most likely case. So say, for example, your best case has a cash flow of 10,000 in year 1, your worst case has a cash flow of 2,000 in year 1, and most likely case has a cash flow of 7,000. Next year, this is 15,000, this is 5,000, and this is, say for example, 12,000. And in year 3, say for example, this is 25,000, this is 12,000, and your most likely case is 20,000. In the question itself, they will give you that we feel that year 1 would have the most likely case scenario. So what do? You will consider your most likely case scenario for year 1. Then question will only specify that year 2 we think best case scenario would be taking place. So you consider this. And year 3, we think again best case scenario will be taking place. So we will consider these. So basically cash flows for 3 years would be 7,000, 15,000, and 25,000 divided by the relevant discount rate. Is this clear? So basically they've given you 3 scenarios. That is your best case scenario, your worst case scenario, and your most likely case scenario. That is why they call this scenario analysis. There is nothing complicated here. Okay, so let's move on to our next part, that is your others. Now this is a very important part, that is your simulation analysis. Simulation analysis, which we also call as Monte Carlo. Now what does Monte Carlo simulation analysis do? The thing that we studied right now were only 3 scenarios, but if you think in a real life scenario, there are thousands of scenarios as to what can happen. Most likely best case and worst case are just our expectations, something that we've grouped a lot of scenarios into 3 categories. Simulation analysis, what does it do? Simulation analysis runs thousands of experiments. It runs thousands of experiments based on probability, and it gives you a range. So it provides a probability distribution. It provides a probability distribution of NPV. I'll change the pen color. Let's change it to blue. So it gives you a probability distribution of NPV rather than a single point estimate of expected NPV. It will not give you a single, it will give you a range. It helps answer questions like what are the possible NPVs and how often does a project produce a positive NPV? Correct, because there is not just one case, there are multiple cases. So we have to understand as to how often is my project profitable or a positive NPV. Okay, let's understand. Everything in red is part of your question, everything in black is part of your answer. Great. So our example starts that what is uncertain? It is uncertain that your annual cash flows we are not able to certainly estimate. Neither are we able to estimate the life of the project. We don't know whether this project will last 2 years or whether this project will last 10 years. What we know is that our initial outlay will be 1,30,000. Okay, perfect. What else has the question given you? Question has given you that annual cash flow. There are these many cases 10,000, 15,000, 20,000, 25,000, 30,000, 35,000, 40,000, and they have given you probability for each case. Okay, they have done similarly for project life. From 3 years, they have taken you to 10 years, and they have given you a probability for each case. What they have also given you is they have given you random 2-digit numbers. Why have they given us random 2-digit numbers? I will tell you. They have also given you random 2-digit numbers because this will help us solve the question. Let's see how. Okay. So what do we do? What happens in Monte Carlo simulation analysis? Basically, if you were to consider this case, there would be n number of possibilities. It could be possible that my annual cash flow is 10,000 and my project life is 6 years. It can also be possible that my annual cash inflow is 25,000 and my project life is 9 years. So therefore, it could be a multiple scenario. If I was to tell you, there would be total 56 cases. How did I calculate 56 cases? 1, 2, 3, 4, 5, 6, 7, and over here we have 8 cases of years. So basically, we have 7 cases of cash flows and we have 8 cases of project life. Multiply it, you will get basically there are 56 cases possible. But we cannot calculate for all 56 cases in our exam, can we? So therefore, this random numbers comes in help. What do? We will first assign them cumulative probability. Sir, what do you mean by cumulative probability? I'll tell you. Cumulative probability. Yes. So cumulative probability basically, first we will write 0.02. Then what do? We will take this 0.02. This we will take 0.02. We will add the next probability, that is 0.03, and we will write 0.05. Then 0.05 we have taken, we will add 0.15, we will get 0.20. Similarly, we will do this for each line item. Got it? In the end, we should be receiving 1 because sum of all probabilities is always equal to 1. So we did this with cash flow. We will also do this with project life. 0.05, then here, then here, here, cumulative probability we will keep calculating and we will get 1 in the end. Now what do? We will assign them a range. We will assign them a range starting from 0 all up the way to 99. Basically, that would be 100 numbers because we are starting from 0. How do we assign this range? We will assign this range based on your cumulative probability. So what do? This probability is 0.02. So we will assign them two numbers, that is 0 and 01. Correct? Next case, your probability is 3. So we will assign them 3 numbers. That is the next 3 numbers. That is 2, 3, and 4. Correct? In next case, the probability is 15. So we will assign them 15 numbers. That is from number 5 to number 19. So we have assigned them 15 numbers here. Similarly, we have assigned them 15 numbers here. We have assigned them 30 numbers here, 20 numbers here, and 15 numbers here. Similarly, we will also do this for project life. That is, we will assign them 5 numbers here. We will assign them 10 numbers here, 30 numbers here, 25 numbers here, 15 numbers here, 10 numbers here, 3 numbers and 2 numbers. We have assigned them a range. Now, now what do you do? What is this random two-digit numbers of use to us? Because it will help us determine the range. What do? You do case number one. You do case number one and you take number 53. Now tell me, where does this 53 lie in this range? In this range of cash flow, where does this 53 lie? Does it lie here? No, 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 no. Yes, it lies in this range, correct? Is this correct or not? Tell me, your number 53 lies in this range. This range is basically 30,000. Is that correct or not? Correct, correct, correct. This range is 30,000. So your case one cash flow would be 30,000. Okay. Take your next random number. Your next random number is 97 and use that now for project life. 97, 97, 97. Does it lie in this range? Correct. That is basically a useful life of 9 years. So your useful life would be 9 years and you calculate what will be my NPV. Is that clear? Let's try another. You will take your random number, that is your random number 66. Where does 66 lie? 66 lies in the range of 35,000, basically this range. So my case 2 would have 35,000. Tell me if this is clear or not. Where does 99 lie? 99 lies in this range, that is basically life of 10 years. So your life is 10 years. Basically, there are 20 random two-digit numbers. So you will have 10 cases because each case uses 2 and you will be coming up with 10 cases. Sir, what is the point of all of this? Those numbers are randomly generated, but your range is not random. Your range is based on probability. So therefore, these randomly generated numbers automatically account for your probability. If a particular range, say for example, this 35,000 range has 20 numbers, isn't there a higher probability that there are more numbers in the random numbers than, say for example, this range? Correct. So therefore, my random two digit numbers are able to account for the probability part. So therefore, I come up with 10 such runs. Each such case is called a run because we are performing a run and we calculate the NPVs. So basically, you do this 10 times and you calculated 10 NPVs and you see that, boss, my only 3 out of 10 NPVs are negative. Is this clear? Only 3 NPVs out of 10 are negative. What does this imply? What does this imply? That 7 out of 10 NPVs are greater than 0, which means there is a 70% chance that this project will be favorable. We have been able to assign probability to a whole project, whether this project would be favorable or not. This, since we have to do this manually in exam, we will be doing only for 10 cases, but in real life, this simulation runs in thousands and millions, and therefore you are able to come at a probability of the success or failure of the project. Is this clear? Has everybody understood what did we do? We were given cash flows, we were given life. We were given probability of cash flow, we were given probability of life. What did we do? We calculated cumulative probability. Then we assigned them two-digit numbers starting from 0, 0. Do not assign numbers from 0, 1. So we assigned them two-digit numbers range. Then what did we do? We took random numbers from that table that was given to us and we made 10 such cases and we calculated the NPV after subtracting this 1,30,000 that was given to us in the question. Right? Then we saw how many of them are negative and how many of them are positive, and we concluded that there is a 70% chance that this project would be favorable. Clear? Let's go to the next part, that is your decision tree analysis. Decision tree analysis helps you make decisions. Sir, what does that mean? It is a graphic display of relationship between a present decision and future event. Of course, every decision would have some outcome, some event, that is outcome or their consequences. Let's try to understand this via question. Perfect. So you are getting into something which requires a testing cost. What is your testing cost? Testing cost is 2.4 lakhs. This is your initial outlay, that is 2.4 lakhs would be required. Okay, perfect. Success rate. Success rate would be 50%. That is, there is a 50% chance of success and 50% chance of failure. If the test succeeds, if the test succeeds, you invest 18 lakhs to generate 4 lakhs income perpetually. Basically, first you invest 2.4 lakh. If it succeeds, then you invest 4 lakh. Then you invest 18 lakh, which will generate 4 lakh income perpetually. That means all year, every year, for lifetime, for all the years, it will give you a return of 4 lakhs. Next, even in case of failure, that is the other 50%. Even in case of failure, you can invest 12 lakhs to get a return of 1 lakh perpetually. Discount rate is 10%. Solve using decision tree. This is your question. Okay, let's see how do we solve this. Basically, if there is a success, you can invest 18 lakh and get a perpetual return of 4 lakh. If there is a failure, you can invest 12 lakh and you can get a perpetual return of 1 lakh per annum. Discount rate is 10%. Okay, so let's first understand as to how do you make a decision tree, what are the square circles and all of this. So your squares are your decision. Basically, whenever you have to take a decision tree, whenever you have to take a decision, these are called nodes. And these lines are called branches. Okay. So nodes are represented by square if you have to take a decision. That means where you have to actively think what to do. That is represented by a square. Okay. So this is a decision. What is the decision here? The decision is whether to conduct the test of 2.4 lakhs or not. Whatever is in circle is your outcomes. This is your outcome. What is the outcome in this case? Whether our test would be a success or a failure. Okay, is this clear? So we start with the decision whether to invest 2.4 lakhs or not, and your circle is your outcome. Your outcome could be, we can either get a success which has a probability of 0.5, or we get a failure which also has a probability of 0.5. Okay. Then you again are caught at a decision whether to invest or not to invest. So that therefore we again have squares, because you have to decide at this point whether you want to invest 18 lakh and get 4 lakh perpetually, or you do not want to invest. So your two options are, you either invest or you don't invest. This is the case in both the scenarios, whether in case of failure also, whether you invest 12 lakh or whether you do not invest. So let's understand whether we should be investing or not. How do you calculate? If I am investing 18 lakhs today and my discounting rate is 10%, if I want to calculate the present value, what do I do? We divide it by discount rate. Tell me, is that right or not? We will be dividing, sorry, not 18 lakh. 18 lakh is our investment. What we will be dividing? We will be dividing 4 lakh. That is the income that we are generating. Correct? So this is the income that we are generating each year. If you want to calculate what is the present value today, you will divide it by your discounting rate, that is 0.10, which is equal to 40 lakhs. So basically 40 lakhs is present value of earning 4 lakhs annually. Is that right? Correct? To earn this 40 lakhs, how much am I investing? What is my cash outflow? My cash outflow, isn't it 18 lakhs? This is present value of cash outflow. Correct? So 40 lakhs minus 18 lakhs give you a NPV of 22 lakhs positive. This is basically my positive NPV. So tell me, does it make sense or not to invest 18 lakh to get 4 lakh income perpetually? Answer is yes, because we are getting a positive NPV. So therefore, in this case, we will be choosing to invest. That is a positive NPV of 22 lakh. Similarly, we will also check that in case of failure, should we be investing or not? Correct? So what was the return that we were getting in case of failure? Return that we were getting in case of failure was 1 lakh. Sorry, I'll write it here. Return that we were getting is 1 lakh. You divide it by 0.10, you will get 10 lakhs as your present value of earning 1 lakh annually. Correct? What is my investment? My investment is 12 lakh. This is my present value of cash outflow. Tell me, my NPV is negative 2 lakh. Negative NPV. Should I invest or not? Should I invest 12 lakh to get a NPV, negative NPV? No. So therefore, if our test fails, what we have decided that in case our test fails, we will not be investing. Therefore, I have colored this in green. We will not be investing, so therefore we will be earning 0 rupees if our test fails. No point making a negative NPV, correct? Make sense? Perfect. Now, what do you do? How do you calculate? Basically, we want to compare, is this test of 2.4 lakh rupees worth it or not? Correct? Because we have decided for box C. We have decided for box C that we would be investing, and for box D that we will not be investing. Now the question comes at box A whether to conduct the test or not. Correct? So tell me, what is the probability that I will earn this positive NPV of 22 lakhs? What is the probability? Probability is of this 22 lakhs is only if my test fails. Sorry, only if my test succeeds. What is the probability of test succeeding? Probability of test succeeding is 0.5. You will multiply it by 22 lakhs. Correct? This is my case if my test succeeds. This is if my test fails, that is 0.5 into what is my outcome? What is my return if my test fails? It would be 0, correct? Because we will not be investing. This gives you 11 lakhs as your expected NPV, or let's not call it NPV, let's call it expected cash inflow. Is that right? So I am expecting 11 lakhs of cash inflow, but to get this 11 lakhs, I have to conduct a test. Is that right or not? I have to conduct a test which costs 2.4 lakh rupees. Does it not make sense that I conduct this test? By putting 2.4 lakh rupees, I have the ability to earn 11 lakh rupees, which brings a positive NPV, of 8.6 lakhs. So therefore, since the NPV is positive, we should go ahead with conducting the test. This was your decision tree. This is the same thing that we have calculated. Make sense? We are investing 2.4 lakhs to reap benefits of 11 lakhs. This is our conclusion. I hope everybody is clear with this. I have tried to go as slow as possible. If you have doubts, please put it in the comment section and we will do our best to clear those doubts. Perfect. Next. Next is your replacement decision. Replacement decision basically has two parts, that is when should I replace an existing machine? In the market, there would be cases where there would be new machine available. When should I replace an existing machine? Is the question. Let's understand this by an example. So the old system, we have some old system in our business, which original cost was 25,000. This old system is 5 years old, whose current market value is only 5,000. Depreciation is done on an SLM basis with a useful life of 10 years. So basically 5 years have already gone and only 5 years are remaining. Salvage value after 10 years would be 0. So our current market value is 5,000 rupees, but salvage value would be 0. Tax percentage they have given you is 30%. There is also a new system in the market which costs 50,000, which has a useful life of only 5 years. Salvage value would be 1,000. But it would also provide, since it is a new system, it would be more efficient. So it would also provide a cost saving annual of 5,000, and there would be additional sales of 10,000 rupees. Okay. This additional sales of 10,000, basically what we are saying is cash profit, you can say. Is that clear? Question is whether this new system should be brought or not. Should we get rid of the old system and bring the new system, or should we continue using the old system? So your step one would be to identify what would be the net cash outflow if I was to bring in this new system. So of course I would have to incur cost of the new system, that is 50,000, correct? And if I sell my old system today, I will be getting 5,000 rupees. Is that right or not? So therefore, my net cash outflow would be 50,000 minus 5,000. Correct? I will have to incur 50,000 and I will get 5,000. What else? You will also have to do tax saving. Tax savings are on what portion? What portion is this? So basically, if you see, our old system was for 25,000, correct? Which was used for 5 years. So today the WDV, the written down value, would it not be half? If our total life is 10 years and we have already used it for 5 years, so the written down value, would that not be 12,500? Correct? And how much are we selling this for? We are selling this for, our selling price is 5,000. So therefore, we have a loss of 7,500, correct? Is that right or not? We have a loss of 7,500 into 30%. Basically, we will get a tax shield on this loss. We will get a tax shield on this loss, which is actually a saving for us. So basically, what would be a net outflow would be 77,500 into 30% would also be subtracted, because this is a saving. So 50,000 minus 5,000 minus 7,500 into 30%, which gives us the value 42,750. This would be my initial outflow. Step 2, we would be calculate what would be the changes in cash flow if the system is replaced. This 42,750 is only for year 0. That is your one-time cost. Next, you have to calculate what would be my annual cash benefits. What would be my inflow benefits annually? So annually, did we not talk that we would have additional sales of 10,000? So we would have additional sales of 10,000. Then did we not say that there would be cost saving of 5,000? So there would be cost saving of 5,000. What else would happen? Your depreciation calculation would also change, correct? Tell me, would your depreciation not change? So your depreciation, that earlier, what were you getting? Earlier, the depreciation that you were getting at 25,000 divided by 10. Per annum, you were getting 2,500. Now what you will be getting? You will be getting 49,000 divided by 5. Why 49,000? Because 50,000 is the cost and 1,000 is the salvage value. So you will be doing 49,000 divided by 5. This would be your change in depreciation. Right? Next. Over here, what we will be doing? We will be doing basically 49,000 divided by 5. 49,000 divided by 5 and 25,000 divided by 10. This is basically your change in depreciation. Whatever depreciation is changing, you will be multiplying it by the tax percentage. You will be multiplying it by the 1 minus tax percentage to get how much of it is still in the business, and then you will add this change in depreciation again. You will get that there is a annual cash saving. There is an annual cash saving of 12,690 rupees. Now we have to understand what will be the present value. So for present value, what will you do? This 12,690 for 5 years at 10%. And do not forget, you will also be getting a salvage value. This is your salvage value at the end of 10 years. Sorry, at the end of 5 years, because your new system has a useful life of 5 years. So this you will discount at 10%, and this you will be discounting by 10% for 5 years cumulative. So we will get that the present value is 48,723. Once you have this, it is simple. You just compare that there is a inflow of 48,723 and there is an outflow of 42,750, leading to positive NPV of 5,973 rupees. Tell me, does it make sense to replace the machine or not? Answer is yes. Does it make sense to replace the system? Answer is yes. Because the NPV is positive, the system should be replaced. What did we do in step 1? Step 1, we calculated cash outflow. Step 2, we calculated annual cash inflow. Step 3, we calculated present value of step 2 plus salvage value. And in step 4, we calculated the NPV. Tell me if this is clear or not. Perfect. We can move on to the next part. Your next part talks about optimum replacement cycle. What is your optimum replacement cycle? Optimum replacement cycle is basically when an older asset should be replaced with a newer asset. What would be my optimum time to change the asset? Because as a machine becomes older, its efficiency decreases, which leads to an increase in operating cost. While at the same time, the more you use the machine, the resale value also decreases. Tell me, is that right or not? As your machine becomes older, you have to spend more in repairs. Maybe the output that it used to give earlier, it does not give the same output as a new machine would. And the later you sell it, the less value you will get for it in the market because the machine is used. So therefore, it becomes important to understand as to when we should replace the machine. We have a formula for this. What is the formula? Equivalent annual cost, which we call as EAC. Equivalent annual cost is equal to present value of cash outflow divided by your present value annuity factor, PVAF. This is not your present value factor, this is your present value annuity factor. Okay, let's understand the example on this. So there is a taxi operator. There's a taxi operator where each taxi costs rupees 4 lakh rupees, whose useful life is 3 years and cost of capital is 10%. You have to determine what would be the optimum replacement cycle. What have they given you? They've given you initial cost, they've given you useful life, they've given you the cost of capital. What else have they given you? They have given you that if we operate it only for 1 year, or your operating cost is 1,80,000 with a resale value of 2,80,000, giving you a net flow of 1 lakh. If you use it for 2 years, your operating cost for that second year would be 2,10,000 and your resale value would drop by 50,000 to 2,30,000. See, there has been a fall, giving you a net flow of 20,000. And if you were to use it till year 3, this gives you a negative net flow of 70,000. Question is whether we should do it or not. Okay, when we should replace the asset, that is the taxi. Okay, we have your cases, that is NPV if the taxi is used only for 1 year, NPV if the taxi is used for 2 years, and NPV if the taxi is used for 3 years. In all of these three cases, your initial 4 lakh investment would have to take place. So therefore, I hope there is no doubt in why we are subtracting this 4 lakh. If we are using the machine only, if we are using the taxi only for 1 year, we will have a net flow of 1 lakh rupees. Is that correct or not? But this 1 lakh would be at the end of 1 year. So we'll be discounting it by the first year discounting rate, that is 0.909, which gives us a negative cash flow of 3,09,100. I hope this is clear. Okay. Next is if the NPV, if the taxi is used for 2 years. If the taxi is used for 2 years, we will first, of course, have the 4 lakh initial cost. Do not directly do 20,000. Your first year operating cost will have to be incurred. That is this 1,80,000. This 1,80,000 you will have to incur for first year. And then for second year, you can bring 20,000 here and discount it by the second year discounting rate. I hope this is clear. Most students do a mistake over here where they will take the year one net flow. No. If you are using the taxi for 2 years, for year one, since you are not reselling it in money, you will only take the operating cost, that is 1,80,000. And then for year two, you will take 20,000. Similarly, for year three, you will do 4 lakh, you will do 1,80,000, then you will do 2,10,000, and then you will do 70,000. That is your net flow. Is that clear? And you calculate their cash flow. Now, you will be calculating the formula that we understood, that is your equivalent annual cost. Equivalent annual cost. If equivalent annual cost, you will be calculating this thrice: one for year one, one for year two, and one for year three. What was the formula? Present value of cash outflow. Present value of cash outflow. Is this not my cash outflow? So I will do 3,09,100. Sir, but you missed the negative sign. The formula already says cash outflow. So therefore, we are not putting in the negative sign. So you will divide it by the PVAF. For year one, this would only be 0.909. For year two, this would be 0.909 plus 0.867, whatever the discounting rate for second year is. And you will get 1.735. And for year three, similarly, you will calculate this. You will get for year one 3,40,000, for year two 3,15,000, and for year three 3,17,000. You have to replace the asset, you have to replace the taxi when your EAC is the lowest. Remember, EAC is ultimately cash outflow. So you have to replace it when your cash outflow is the lowest. So at year two, your cash outflow, that is your EAC, is the lowest with 3,15,000. Therefore, the optimum replacement cycle for a taxi is 2 years. Every 2 years, you should be replacing your taxi. If you use it for more than 2 years, you would actually be having a loss. Is that clear? Everybody clear? EAC formula is clear. How we solve this question is clear. Perfect. Let's go on to the last part of this chapter, that is your adjusted present value. What is adjusted present value? Adjusted present value is based on the concept that, sir, whenever I calculate NPV, what do I discount it with? I discount it with my weighted average cost of capital. Tell me, is that correct or not? But every company has two departments. One is your investment department that chooses where to invest, and second is your finance department, because of whom my WAC plays, because of whom my WAC changes. So my investment decision is deciding where to invest based on this WAC. Is that right or not? Because we use WAC to discount. So the question comes that, boss, if the finance department of a company is fucked, why should I stop investing just because my WAC is messed up? So therefore, the concept of adjusted present value comes that, boss, I will not use WAC. I will not be using WAC to discount my project. I will be using something else. Is that clear? Is that clear why we are doing this topic? Because It is used to analyze projects by breaking it down into two parts, that is base case NPV and present value of tax shield on interest. Let's study with an example. Your initial investment is rupees 100 lakhs. Okay. Project life is 5 years. Cash inflow is 30 lakh per year. Your cash inflow is 30 lakh per year. Outflow is 100 lakh. Life is 5 years. Your unlevered cost of equity, basically without the effect of debt, is 12%. This is your cost of equity, that is KE. Our borrowings are at 50 lakhs at 10% interest rate, and they have given you tax at 30%. Right? So what would we have done in a real life scenario? We would have put a weighted average cost of capital using this 12% and using this 10% into 1 minus 0.3. That is what we would usually do. But if we are doing adjusted present value, we will be using only this 12%. I'll tell you how. So we will be calculating first is your base case NPV, that is present value of 30 lakh. That is your cash inflow at 12% for 5 years. You will subtract 100 lakh, that is your investment, and you will get a value of 8.5 lakh. This is assuming the company has no debt. This is assuming the company has no debt, that is this project gives me a positive NPV of 8.15 lakh if my company did not have any debt. But my company does have debt. So what would be the present value of tax shield? That is 50 lakh into 10% into 30%. Correct? This you will discount by 10% for 5 years. Tell me, is this clear or not? Correct? So you will get a figure of 5.69 lakh. This is basically your tax shield due to interest payments, bringing the adjusted present value to 13.84 lakhs. So basically out of 13.84 lakhs, my 8.15 is because of the project itself and 5.69 is because I have debt in my company. Is this clear? With this, we are done with this chapter and I will see you in the next one.